So, have you ever really stopped to think about how your bank makes money? I mean, really makes money? The answer? Well, it might just change how you look at your savings account forever.
Okay, let's just dive right in with a pretty provocative statement. Your bank makes more money from your savings than you do. Now, by the end of this, you're going to see exactly why that's not just some catchy phrase. It's literally the heart of the entire banking business model.
So how do they pull it off? The secret is surprisingly simple. At its core, a bank is just a business. It buys and sells something. The only difference? Its product is money.
Let's make this super simple. Think about your local shopkeeper, right? They buy a product for, say, 80 rupees and sell it to you for 100. That 20 rupee difference, that's their profit. Simple. Well, a bank works on the exact same principle. It buys your money by borrowing it from you at, let's say, a 4% interest rate, and then it turns around and sells that same money by lending it to someone else for 10%. And guess what? That difference, that's their profit.
And that right there, that brings us to the most crucial point of all. Your money, it's the fuel for their profit engine. The cash you deposit isn't just sitting safely in a vault somewhere. Nope, it's the raw material for their whole business operation.
Okay, so where does all this money they're selling actually come from? Well, surprise, surprise, it comes from us. It's the money in your savings accounts, your fixed deposits, even the cash floating around in current accounts. Of course, they also borrow from other banks and, importantly, from the central bank, which here in India is the Reserve Bank of India or the RBI.
All right, let's put some numbers to this to make it crystal clear. Imagine you go to the bank and deposit 1 lakh rupees into your savings account.
So on that 1 lakh you deposited, the bank might give you what, 4% interest for the year? But then they take that exact same money and lend it out as a car loan or a personal loan, and they'll charge the borrower a much higher rate, maybe 10%. You see that gap? That's the magic number. That's where the bank makes its money.
Now, in the finance world, they have a fancy name for this gap. It's called the net interest margin, or NIM for short. It's really just the difference between the interest the bank earns on loans and the interest it pays out to depositors like you. And let me tell you, this is their single biggest source of income. It's the bread and butter of banking.
Let's do the math real quick on that 1 lakh rupee example. At 10%, the bank earns 10,000 rupees in a year from the loan. Out of that, they have to pay you your 4% interest, which is 4,000 rupees. So what's left over? 6,000 rupees. That's their gross profit from your money. Now take a second and just imagine that simple calculation, but scaled up across millions of customers and, well, billions and billions of rupees. Yeah, it adds up fast.
Okay, but wait a minute. This should raise a pretty big question in your mind. If the bank is lending out my money, what happens if I suddenly need it back? What if I want to withdraw it? Well, this is where a huge safety net comes into play. Because no, they can't just lend out every single rupee they take in.
So let's ask it directly. Can a bank legally lend out 100% of the money you deposit? The answer is a very firm no. And the reason why is all about keeping the entire system stable. And that reason has a name. It's a regulation called the Cash Reserve Ratio, or CRR. Basically, it's a mandatory rule from the central bank. It forces all the other banks to keep a certain percentage of all their deposits locked away in reserve, and not just anywhere, but securely with the central bank itself.
So, for example, if the CRR is set at 4%, it means for every 100 rupees you deposit, the bank has to send 4 of those rupees over to the RBI for safekeeping. That leaves only the remaining 96 rupees that they can actually lend out to make a profit. It might not sound like much, but this acts as a critical safety buffer for the whole financial system.
This whole system, holding a fraction of deposits in reserve and lending out the rest, well, that's the foundation of modern banking pretty much everywhere in the world. And it has a name you've probably heard, fractional reserve banking.
So that net interest margin is definitely the main event. It's how banks make most of their money. But it's not the only way. They have a few other tricks up their sleeve. So let's take a quick look at their other income streams.
Yeah, beyond just interest, banks are absolute experts at generating revenue in other ways. We're talking fees for all sorts of products, income from their own investments in things like stocks and bonds, and of course, a whole bunch of service charges.
I'm sure you've seen these on your statements before. Things like loan processing fees, those annoying late payment penalties, annual credit card fees, even foreclosure charges, which is when they charge you for paying off a loan early. Wild, right? Each little fee might seem small on its own, but trust me, when you add them all up, it becomes a massive stream of revenue for the bank.
But here's the thing.
All of this, the entire global banking system, it only works because of one invisible asset. It's something you will never, ever find on a balance sheet, and that asset is trust. So let's talk about the trust, the risk, and the reality that holds this whole thing together.
This brings us to a really dramatic but super important question. We know the bank has lent out most of its deposits, right? So, what would happen if everybody, all at once, wanted their money back at the exact same time?
Well, that catastrophic scenario has a name. It's called a bank run. It's what happens when people lose confidence in a bank and a huge number of them rush to withdraw their money all at once. And because most of that money has been lent out, even a perfectly healthy bank can literally collapse under that kind of pressure.
And that is why trust is the ultimate currency in banking. It's our collective faith that our money will be there when we need it. And look, this trust isn't just some hopeful, fuzzy idea. It's backed up and enforced by heavy-duty government and central bank regulations, exactly like that CRR we were just talking about. So what's the big takeaway here? It's this. You have to remember that banks are businesses. They are not charities. Now, they play an absolutely vital role in the economy, for sure. They help people buy homes, they help companies grow, but their number one goal, just like any other business, is to make a profit.
And that leaves us with one final, pretty powerful thought to chew on. When your money is idle, it is working harder for the bank than it is for you. Now, understanding this doesn't mean you should start distrusting banks. Not at all. It just means you can start thinking about how to make your money work harder for you, and not just for them.